Kenya's government may have agreed to reduce its stake in Safaricom from 35% to 20%, but authorities here are still keen to see the telecommunications company split into 3 units. Put simply, the government is in talks with Vodacom, which will own 55% of the company once this transaction is completed, to split Safaricom into a mobile phone tower operator, a fintech company, effectively where M-Pesa would be housed, and a standalone telecommunications company. In November, the World Bank urged Kenya's communications regulator to use updated regulations to encourage infrastructure sharing. A curious component of this deal, however, was an upfront payment of $310 million to the Kenyan government in lieu of dividends due to the state through its smaller 20% share in Safaricom. In the sessional paper provided to legislators, however, the Finance Ministry did not provide details on the key assumptions and the math behind that loan. The Finance Minister says the proceeds will not be spent directly in a normal annual budget. Vodacom, however, disclosed that it did seek a fairness opinion on the deal from Deloitte as an independent third party. And in it, it opined that the $2.1 billion deal was essentially fair to Vodacom shareholders. But was it fair to Kenyan shareholders? When I spoke to the Kenyan Finance Minister, I asked him why the ministry did not have an independent transaction advisor for this multi-billion-dollar deal.
We actually largely discussed between us and the shareholder. And you see, Deloitte and Twitch is actually Deloitte is a big company which can serve both. They are professionally engaged. You don't have to go again and spend much more money in getting a technical team to work on the project, especially at this preliminary stage. We are moving to the execution stage, where we will now get to have transaction advisors into it. So if you do it in the preliminary stage and again do it at the execution stage, it is a necessary expense in our view.
Okay, so in this preliminary stage, it was done entirely by Treasury. Yes. Have you identified a transaction advisor for the next stage?
No, we haven't. We will get to that. So that will be a recruitment process.
Q1 of 2026?
Yes, definitely, yes. And we can't get to that stage, Rama, because you will be assuming that Parliament has already approved the process, and that is a wrong assumption. We must go through the process. This was a proposal initiation, a very preliminary stage of it. And then now is when we are moving to Parliament. National Assembly is already seized of it. And then once they are done and give us the go-ahead in terms of approving the sessional paper, then now we move to the next stage. That is how you do this kind of diversity or privatization. The next stage now will involve execution, and now we will get the professional advisors to come in.
What if your transaction advisor says, well, we think that this price at 34 shillings a share, about 26 US cents per share, is a bit on the low side? Do you have room in the agreement that you have now with Vodacom for that price to vary?
You see, that will be discussed at that time. I don't want to preempt it. But again, this process has just begun. A process that has begun. You see, we have already gone on to do the proposal initiation and communicating to Kenyans that this is what we are agreeing with Vodacom on. Now, the National Assembly may have its own opinion, and that opinion, again, would inform a further discussion. And then we can get to advisors telling us 1, 2, 3 during execution. That will be discussed. But you see, it would probably work against the whole process if I start making my opinion known about this at this stage.
With respect to the dividend-backed loan, one of the arguments I've heard about it, at least the impressions I got from it, is that this might have been necessitated by a liquidity squeeze on the Treasury side. Because looking at your external borrowing plan, for example, there's a few in there that haven't materialized. The World Bank DPO loan, for example, you'd penciled in $1.2 billion for that. That's not come through yet. The $1 billion debt for food security swap, that's in progress, but it hasn't come through yet. Was that lack of external funding a key driver for structuring this deal such that it would also have that dividend-backed loan coming in?
We are sounding like it is a crime to talk about financial challenges or fiscal space. It is a fact that Kenya, where we are at the moment, the reason why we are even exploring these options is because we have come to realization that we cannot continue the same way we have been doing things. One, we cannot overtax Kenyans anymore. We must look for other sources of funding for our budget and other public investment expenditure. We cannot go and borrow more money from the market and many other places where we have been borrowing, because A, the sources of funding are getting dry. The taps are drying up from our major development partners, and even the multilaterals, they are becoming, the funding is getting drier, they are squeezed like any other person. There are a lot of challenges. So that option is also not available. And again, we have huge debts in our books. So it is a fact that we need to look for other sources of funding. And one of the ways is to get to divest, get to privatize, get money, seed money, and invest. But thinking about it, that we are raising all this money for short-term expenditure is not correct, or short-term budgetary support is not correct. We are not trying to plug the budget deficit. This money we are raising, these resources are supposed to be put in the National Infrastructure Fund, which we are creating, which is going to be a company limited, a limited liability company, and which company will now be professionally run. And this company is going to have this seed capital and going to crowd in private sector, which therefore would help us to put up major infrastructure projects. So it is going to help us in this way in terms of managing our budget. Remove some of these capital expenditures, which are very heavy on our budget, which are commercially viable, take them off, put them under the arrangement of National Infrastructure Fund,